Hello, I am George Langelett, and I am a professor of economics in the economics department. Thank you for watching this iPod broadcast, and today we're going to be dealing with the issue of the short-term economic outlook for both the nation and for the state of South Dakota. My presentation today will cover three parts. The first part, we're going to go back to look at the causes of the 2008 recession. Second part, we're going to look at the state of recovery for the U.S. national economy. And the third part, we're going to look specifically at South Dakota and the recovery from the recession for our state here in South Dakota. First, part one, we're going to look at the causes of the 2008 recession. And this primarily was a result of what I call financial innovation and also deregulation of the financial industry. And when we're talking about the financial innovation, we're talking about some creative new products created by the financial industry, including taking debt. We call it debt securitization. That's kind of a fancy term. They take different types of debt, for example, home mortgages or auto loans. They take a bunch of them, they bundle them together, and then they sell it on the secondary market as a bond. So debt securitization, also derivatives. When we're talking about derivatives, we're talking about an instrument that has no value in itself, but derives itself from another instrument. For example, the value of this bond you created really depends on the value of the houses that have been bundled together to create this bond. And the rating agencies, Standard & Poor's and Moody's, together rating these financial instruments, really encourage risk-taking throughout the financial industry. Two key pieces of legislation that were key to the 2008 recession. First of all, we have the Graham-Leach-Bliley Act repealing the Glass-Steagall Act of 1933. And this was significant. The Glass-Steagall Act of 1933, with large banks, prohibited its split banks, and banks were not allowed to be both commercial banks and investment banks. We think of commercial banks as traditional banking, where the banks participate in traditional methods like home mortgages, auto loans, commercial lending. And then investment banking, we're thinking of banks participating in the stock market, getting into derivatives, options markets. This was not allowed under the Glass-Steagall Act. Well, in 1999, the Graham-Leach-Bliley Act amended and replaced it. It repealed the Glass-Steagall Act. The Graham-Leach-Bliley Act said, no, banks can now do both. So your four largest banks, looking at Bank of America, Citibank, Morgan Stanley, and Wells Fargo, all of a sudden could participate in both sets of markets. Well, they really looked at where the best return was, and this really encouraged risk-taking, getting into the riskier investments and away from traditional lending to households and businesses. The second piece of legislation that was key was the Commodity Futures Modernization Act. And this deregulated financial derivatives. We talk about agricultural derivatives, but we also have financial derivatives, and they were very highly regulated. This Commodity Futures Modernization Act got rid of most of the regulation. It became deregulated and opened up some real creativity among the financial institutions, and that increased risk-taking throughout the industry. This next slide we see here was an amazing trend. If you go back to 1985, there was basically no asset-backed securitization taking place. By 2008, it was a massive industry. We see in this chart here, there are many types of loans: student loans, credit card, automobiles. And banks would bundle up a bunch of credit card loans and securitize it, meaning they create a bond out of it, and then sell it on the secondary market. And banks were able to significantly expand their business model by selling all this debt. They create loans for automobiles, for credit cards, other types of student loans, and they bundle it together and sell it on the secondary market. This created a whole different complexity to the financial institutions, and we see this trend growing exponentially throughout the 1990s. Okay, on this next slide, we see the nature of the mortgage market. To understand the crisis of 2008, we have to see what has been taking place in the housing market. In the upper left corner, we see the traditional source for house mortgage, home mortgages, has been savings and loans. And in 1970, well over 50% of all mortgages were from savings and loan. 1980s, because of some severe risk-taking on behalf of savings and loans, we see a collapse of the industry, and by year 2000, less than 10%. If we look right below that, commercial banks, their share of mortgages has remained relatively steady from about 40% down to about 30% over 3 decades. And where has the slack been taken up? Well, if we look in the upper right-hand corner, we see government-sponsored enterprises, specifically Fannie Mae and Freddie Mac. And 1970, they were doing virtually no mortgages, financing them. By 2010, well over 50% of mortgages are now financed by Fannie Mae and Freddie Mac. Bottom right-hand corner, we see some other agencies, Countrywide and a few others, which went bankrupt, picking up also the financing of home mortgages. This next slide, we see here this phenomenon of derivatives. Now, derivatives were created by the financial institution to increase leverage. And if we notice the scale here, it's not in billions, but in trillions of dollars. If we're thinking of the U.S. economy around a $15 trillion economy, this gives some perspective. We're looking here by 2009, we were up to $30 trillion in derivatives. And there's a black line, and this is the notional amount. This is the face value. We also have the gray bars, which are the market value. So you see a lot of these derivatives were significantly discounted because of the riskiness of them. So we see this national explosion of financial derivatives being sold in the secondary markets. Now, the cause of the crisis, I'm going to argue, is dysfunctional incentives in the wrong places. We have 2 rating agencies, Standard & Poor's and Moody's. In 2006, they would bundle mortgages together and sell them as a bond. 30 mortgage securities each day were ranked AAA by Moody's, and AAA is the highest bond rating possible. By 2010, in comparison, only 6 companies in the United States still had a AAA rating in terms of credit. 2000 and 2007, 45,000 instruments, companies, were rated AAA by Moody's. In the next few years, 83% of these all lost their AAA rating. The bottom, I find a very fascinating statistic. September 6, 2008, Fannie Mae and Freddie Mac, these government agencies, were rated AAA by Standard & Poor's. The very next day, they were in receivership. They were in bankruptcy. So we see how deceptive or how misplaced some of these ratings were by Standard & Poor's and Moody's. To give us some understanding of what was going on, we have traditional banking, and traditional banking is receiving deposits, savings accounts, and then lending them out to traditional businesses. This includes auto loans, home loans, loans to businesses. This is traditional banking. We also have the term called shadow banking, and this is other alternative activities, including bundling mortgages, selling them as securities, doing repossessions. For a while, banks did not mind repossessions because housing prices were going up. So we had this shadow side, and we see by 2007, the shadow banking had replaced traditional banking for most of the banking industry. Banks were focused on this more profitable shadow banking, and this caused significant distortions within the banking industry. 2008, we see this collapse of all this shadow banking, and we see some of the difficulties it was creating within the banking industry. And a note here, we got to remember banks are trying to maximize their profits. So with financial deregulation, they were looking for the most profitable place to invest their money, and they got away from traditional banking. And it's been criticized by a number of agencies, the concern about traditional banking leaving, or banks leaving traditional mortgages for these more risky type of investments. So this all really culminated in 2008, and we see the results here. We have prime loans and subprime loans. Subprime loans are given for people who do not have the credit scores to get a prime mortgage. Now, if you think about it, that's very risky business if they don't have the assets or some other credit issues to receive a prime mortgage. Banks were still willing to give these people mortgages, but at a higher rate, and banks were actually excited about this because it was more profitable. Well, if you think about it, if people cannot qualify for a standard mortgage, there are issues. And all of a sudden, this business model started catching up to banks in 2008. So by 2008, we started to see massive amounts of defaults, especially in the subprime market. We have fixed rate over the duration of the loan, and we also have adjustable rate, where every 5 years they will adjust the rate of the mortgage. By 2009, 40%, over 40% of the subprime mortgages had in fact defaulted, and we see an implosion of both the housing industry and bringing down the financial industry. There was some concern that the entire financial industry may go insolvent, and this was the real cause of the 2008 recession. I'm going to change here now to part 2. What has happened? We saw the cause of the recession, but where are we today? Basically, the U.S. economy is struggling to recover from what we call the Great Recession. Many people are calling this not just a recession, but the Great Recession. But today, increases in manufacturing activity, consumer spending, and employment suggest our expansion will continue. This next slide gives some perspective to our recession. The dark black line shows our 2007-2009 recession, significantly deeper and longer in duration than our past other 5 recessions. Up to 5% of GDP was gone. It's an amazing number. Right-hand side, we see the effects, 8.8 million jobs lost, and according to the U.S. Treasury, $19.2 trillion in lost household wealth. If you take and divide that number by 300 million Americans, on average, we lost $64,000 per person was lost in real wealth among household wealth. This next slide shows a picture of what happened in 2008. We see late 2008, the economy had a massive downturn, and this chart, a reminder, is in 2005 dollars, so it's in real dollars. We went from well over 13,000 to about 12.5, a significant downturn in the economy. This caught the Fed's attention. We'll talk about that in a minute. Fed kicked in some policies, and we see since 2009 a slow but steady growth to the economy. This next slide shows the Fed's response to the financial crisis. And the Fed responded with the largest injection of money into the banking system in U.S. history. The Federal Reserve more than doubled its balance sheet January 2007, it was less than $1 trillion. By January 2009, it had doubled to over $2 trillion. Also, to encourage banks to lend, to make things more profitable for banks to lend, the Federal Reserve lowered the federal funds rate to 0.25%, so not even 1%, but 1/4%. This was the amount banks had to pay for borrowing costs to encourage them to make loans more profitable. This next slide, we see here what happened to the Fed's balance sheet. Our Federal Reserve, our central bank, said, you know what, we're afraid that banks may collapse, so they injected massive amounts of temporary loans, easy money, into the banking system. The blue area on top, that is short-term loans to banks. They pumped money into the banking system to make sure that our banking system was solvent. And again, we have to remember Ben Bernanke, our chairman of the Federal Reserve, he is a master, he is a student of the Great Depression, and his primary concern is to make sure we did not repeat the Great Depression. And his massive injection into the banking system did stabilize our banking system, did lower fears in terms of a collapse of the banking system. Things stabilized and our economy started to grow. This next slide shows the results throughout late 2008, early 2009. Bernanke was pumping billions, actually trillions of dollars into our banking system to get it to stabilize. Since 2009, we've seen slow but steady growth. It's been up and down each quarter, but it's remained positive, and the trend looks to continue. To give us another picture of the economy, this slide helps put things into perspective. Left-hand side is employment. 2008, 2009, we've seen a massive layoff of the American public. 8.8 million jobs lost. We see in January 2009, in that month alone, almost 900,000 jobs were lost. Late 2009, the Fed policy started kicking in, and we reversed that trend. Companies quit laying off and started hiring. So since 2010 onward, we've had a steady growth of employment, both in our economy. Right-hand half of this slide shows our economy, and we see 2008, 2009, a massive slowdown in our economy. Fourth quarter 2008, our economy lost almost 9% of the economy in that quarter alone. By late 2009, federal policy had kicked in, and we've seen continual growth since 2009, on average about 2.4% annual growth. To give us a picture of what's happened with this recession, we have unemployment, and we see 2007, we were less than 7 million people unemployed, and that number shot up significantly through 2008 and 2009. By 2010, we had almost 15 million people unemployed. Or in percentage terms, in 2007, we were down almost to 4% unemployment. By 2010, that had shot up to 10%. And since 2010, we've seen a slow but steady decline. Today, the unemployment rate is a little bit less than 8%. This next slide shows kind of a comparison. We have the unemployment rate. We also have another statistic called U6. And U6 is a combination of unemployment and underemployment. We're talking about underemployment, we're talking about people who are employed part-time but would like to have a full-time job. So we're adding those people into the unemployment figure for U6. What's the result? We see an amazing number. If we add in both unemployed and underemployed, by 2010, 17 million people were either unemployed or underemployed. That's a massive amount of people in our workforce, unemployed or underemployed. Normally that number is about 3% difference between unemployed and underemployed. By 2010, it had jumped up to a 6% difference. People who are not unemployed, but they are underemployed. Okay, for this next slide, we're going to break things down a little bit further. We're going to break down economic growth between the private sector and the public sector government. First, with private sector, we see as a result of fear in the 2007-2008, a massive slowdown in the private sector, losing well over 10%. And then as Federal Reserve policy starts to kick in, banking starts to stabilize, the private sector becomes much more stable, confidence rises, and it returns to form, and the private sector starts growing. That growth continues through to 2010, has fully recovered, plus about 3%. So over this time period, private sector has grown 3%. If you contrast that to public sector government spending has been relatively flat. When talking about government, we're talking about the federal government, state government, and local government. And it's been relatively flat over time, relatively stable. But because of cutbacks in federal spending and also cutbacks in state and local taxation, state and local governments have had significant layoffs. 600,000 people between state governments and local governments have lost their job. So there has been a fall in government employment. So overall, the economy, the private sector continues to expand, and the government at this point is starting to contract. To kind of give us some perspective, we're going to look at private sector output, 2008 to 2011. 2008, we need to look at, there's three different colors here. The red is just GDP to give us kind of a benchmark. And then the blue is private sector for services. And the yellow or orange is private sector for the goods producing. What do we see in 2008? Massive hits to the goods producing. Same thing 2009, this was the depth of our recession. We see both the private sector goods producing and the private sector services all falling. We see by 2010 all of these sectors recovering, GDP growing at 2.4 and private sector goods going at 2.9, private sector services 2.7. So we see positive growth starting in 2010. This next slide looks at inflation, the consumer price index, and to put things in perspective, the baseline for this is 100 is 1981, 1982, and that was just after the inflation of the 70s, so we had some price stability then. That became our benchmark. What's been happening? We see here 2007, we started to have some rise, that sharp jump up, and then 2008, as the economy collapsed, we see a downwards price pressure, especially in the goods, durable goods. Then starting 2009, we see a continual upward trend. So over the 2007 to 2012, we have basically on average about 3.4% inflation over this period. Okay, for this next slide, we're looking at the sources of inflation. The red lines are really just kind of a benchmark GDP, and then the blue is private sector services once again, and the orange or yellow is private sector goods. And we see 2008, things were going along, normal price rises. 2009, services continued to increase 2.3. The price of goods take a massive hit, lost 4.6. Automobiles, a lot of different industries, they were not selling, so they had to lower prices to get clearance of inventories. 2010, Fed policy started kicking in, so things stabilized. And then by 2011, companies were able to recover some of their margins, especially in the goods industry. So if we look at the orange in 2009, they lost it. In 2011 was an opportunity for companies to make back their margins. Okay, this next slide is a very important slide. It's produced by the Institute of Supply Management. It's called the PMI, so the Purchasing Managers Index. Every month, the Institute of Supply Management does a survey of purchasing managers around the nation, and we get what's called a PMI index. Now, the key with this is the number 50. So a number 50 is neutral. Any number above 50 means an expansion of the industry. Any number below 50 means industry is contracting or managers are pessimistic about the future. What do we see on the left-hand side? We see PMI is for basically the manufacturing industries. And we see, except for last summer, we see a very healthy trend. Last summer, July and August, is below 50, and last November. But since then, we've had nice numbers come in, 50, and then January and February, 53 and 54. So we see an expansion of the economy according to purchasing managers. On the right-hand side is the non-PMI, and this is for the service industry. What do we see across the board? Throughout time, numbers well above 50. So our service sector of our economy is growing nicely, and this trend is expected to continue into the future. Okay, this next slide presents a summary of the U.S. economy. Our economy has been slow but steadily recovering, and this expansion is expected to continue into the near future. One concern that I've been asked recently several times is the issue of the current federal government's current sequestration. And people ask, what does sequestration mean? It's really just a fancy term for government cuts. And the current cuts for this year are about $85 billion. Over the next decade, there'll be $1.2 trillion. The cuts for this year are $85 billion. People ask, is that a problem or not? Well, it is a cut, but $85 billion is relatively small compared to the federal government's $3.8 trillion budget. So if we look in billions, $85 billion cut from $3,800 billion is not all that big of a cut. So it will have effect, but will not have significant effects on the U.S. economy in the near term. Okay, now for part 3. What about South Dakota? How are we doing in South Dakota? Well, there's good news. For years, South Dakota has lagged the national average in per capita income. In 2011, this has changed. The average for the U.S. economy, $41,500 per person or per capita. South Dakota is now exceeding that at $44,000. Kind of a little trend in recent history. We're looking at the history of South Dakota. For years, we've lagged the national average. 2001 through about 2006, we were about at 90% up to 95%. And this is really good news for us, but our local economy has been growing well, where the national economy has relatively stagnated. And 2010, we reached about 100%. In 2011, that number jumped to 105% of the national economy. And it looks like that trend will continue. There's some questions on the ag economy. We have some concerns on ag prices and the drought, and we'll talk about these issues in a minute. But for the most part, it looks like we're on solid footing here in South Dakota. This next slide breaks down the South Dakota government by sector, and we're going to break down the economy here in South Dakota. By far, the largest sector is the financial services, financial insurance. About 15% of our economy. We think of the large banks down in Sioux Falls with their credit card operations. Next sector is government, and this includes both state government and local and city government. So school boards are in this. Your local police, fire departments are also included in this. Next is agriculture, a large contributor, is well known as an agricultural state. And next, both healthcare and social assistance. Healthcare is growing each year, in manufacturing, both about 9%. Then real estate and retail trade coming in next. Real estate about 8% of our economy. So if we look at most of these industries, they've been growing quite well throughout this last 4 to 5 years. Breaking things down, in 2011, our GDP for South Dakota was $40.1 billion, and it's 47th, but got to remember, we only have 800,000 people in South Dakota. If we break it down on a per person basis, we're doing better than the national average. In 2011, our economy, GDP, grew at 0.8%, and the largest industry, financial services, had some healthy growth, and it really accounts for 15% of our economy, and it contributed 0.1% of growth to the South Dakota economy. Agriculture accounted for 11% of our economy here. 2012 was a little trying year with a drought, but the agricultural prices have been helping that industry. In terms of growth, the largest contributor this last 2 to 3 years was growth of the durable goods manufacturing in South Dakota. Think of industry, we think of here in Brookings, we think of Daktronics, Larson Storm Doors. Think of in Sioux Falls, we think of Raven Industries. 3M has plants throughout South Dakota, and the durable goods industry has been doing quite well here in South Dakota. The durable goods has accounted for 0.55% of total GDP growth here in South Dakota. Also, second is real estate, been doing very well here. Prices have been going up, both housing prices and land prices. And Argus Leader recently has had several articles. Sioux Falls, I know here in Brookings, Watertown, real estate prices have been going up, and the supply of houses is getting very tight. So real estate is doing very well here in South Dakota. And real estate account for 0.23 percentage points of growth here in South Dakota. So to summarize it, overall our economy here in South Dakota has weathered this Great Recession better than the rest of the United States, primarily to the stability of the agricultural sector and now the strength of both the financial services and manufacturing here in South Dakota. And this economic rebound is expected to continue during the near term and continue to contribute to the growth of the South Dakota economy. Right now, South Dakota, actually along with North Dakota, South Dakota is one of the best positioned states throughout the entire country. So really, in summary, the national economy is doing quite well right now. We're gotten some footing. There's still some headwinds, but overall the near-term growth looks very encouraging. And here in South Dakota, things look very strong. We have not had the deep recession that the rest of the country has had, and we're continuing to grow both the financial services. Tourism is doing very well as the rest of the nation recovers, and manufacturing is doing well. And hopefully, if the weather eases, we'll have some great output also in agriculture this year. So thank you for your time, and thank you for listening to this podcast.